afternoon. Thank you for joining us for today's presentation presented by Marsh and Beasley on emerging management liability hurdles in healthcare. This is going to be an interactive presentation, so you're going to hear all the speakers kind of giving their opinions as we go forward. Just so you know, this presentation is being recorded, and if you so desire, we will send you a copy of the PowerPoint presentation as well as the recorded presentation via email after today's session. We also openly welcome your questions, so if you see in the webinar the little Q&A panel, feel free to type in your questions there and we will do our best to address them during the session. And if we don't get a chance to do that, we will try to reach out to you afterwards. So with that, we'll get started and we'll start with introduction. So Nicole, do you want to go from there?
Hi, yeah, so good afternoon, everyone. Thank you so much for dialing in and tuning in to our webinar today. I am Nicole Francis. I am helping to co-lead the Financial and Professional Lines Healthcare practice along with Ruth. So thank you so much for letting us spend some time with you today to talk about all of the very dynamic and emerging risks we're seeing in financial and professional lines for our healthcare clients.
Yeah, and so we're going in the order of the pictures, so you want to put a face to a voice. So now I'm going to introduce myself, Ruth Kokendorfer. I work closely with Nicole. We are the co-leaders, as she mentioned, of our FinPro healthcare practice. And we work on accounts across the country, from senior care to large acute care to large managed care risk to small managed care risk. You name it, we touch it. And now for our invitees to today's presentation, Greg.
Hi, everyone. My name is Greg Getz. I'm Beasley's focus group leader on the claims side in the healthcare management liability practice. I'm, at least what I understand, to be a little bit unique in that this is my sole focus. Like the management liability in the healthcare space is all I do. So hopefully there'll be a good bit of experience on the claims side I can share with everyone on the call today.
And Kelly.
Hi, and thank you. And this is Kelly Webster. I am Beasley's healthcare management liability focus group leader on the underwriting side. I sit here in Chicago, and as part of that role, I underwrite and manage and am responsible for the performance of the healthcare management liability book of business, which would include directors and officers, employment practices, regulatory, billing, E&O, and fiduciary liability.
Great. So let's get started. Nicole.
Yeah. So I think we can all agree that this is a pretty dynamic and challenging time for us all, but really specifically for certain industries like healthcare specifically. You know, healthcare industry has had to pivot and not only protect patients and their safety, but all while grappling with this new realities and risks that we are all facing in a time of a very unprecedented pandemic environment. But with these challenges, we also see great opportunity ahead of our healthcare clients. It's a good time to reevaluate procedures and explore new ways to deliver care in a post-pandemic world. So today we wanted to really drill down on some really specific issues facing our healthcare clients today. We want to focus on an ever-changing subset of risks that our clients face in their upcoming and maybe ongoing management liability renewals. We will address some increased risks facing our clients while also providing some helpful tips and tricks that we hope will help mitigate increased exposures for potential claims. We also want to spend some time addressing the greater impact in the insurance market as our carrier partners highlight their perspectives on our clients' new realities of risk as well. So with that, we really just wanted to, what this graphic is really looking at are all the different, liability hurdles as we see that our clients faced. When the world kind of shut down, I believe it was March 14th of this year, Ruth and I started to really drill down and think about the different risks that might impact our clients as we kind of navigate in a post or an ongoing COVID world. And some of these risks that we wanted to touch on, you can see we'll go around the wheel and talk about these, but we'll also dive a little bit deeper in the following slides as well. But just to start out, on the top left part of our circle here, circle graph, are some of the risks that we've seen in cyber and crime insurance. Obviously, again, when the world stopped, there was such a huge surge in all the work from home activities. And with that could, create a certain amount of increase in cybersecurity gaps potentially. It's no secret that security incidents have soared as a result of all of us now working at home. In a recent study put out by Malware Bytes, we saw that 20% of organizations had some type of cybersecurity breach. So I think it's just a really good point that, it's a good time to reevaluate your software platforms, especially in a healthcare environment in protecting HIPAA. We've also seen a huge increase in email phishing. I'm sure that everyone is getting those notes from your IT departments and just kind of reminding everyone about the email phishing that we're seeing by cyber criminals. Cyber criminals have really increased their bandwidth and their presence in highlighting how difficult of a time this is, and we're seeing that the increase of malware is also something that our clients are really grappling with. We're also looking at, risks that also impact fiduciary liability insurance. And what we're really concerned with are employers and their communication around benefit determinations in a very shifting workforce. We have clients that have employees going from part-time to full-time, and making sure that their benefits track with the changing part-time and full-time status. And also looking at medical determinations as well for furloughed employees, and just making sure that we're communicating with our clients that they have a duty to communicate any plan changes to their employees early and often. And it is also really important, and we're going to touch on this a little bit later in our webinar, to know that there's a very active plaintiffs bar in tackling excessive fee litigation. So these are, just some of the fiduciary liability risks that our healthcare clients specifically are facing right now. As we look at wage and hour and what some of those risks look like, in the bottom middle quadrant of our graph, we're looking at what those temporary furloughs look like, and then also pushing, a lot of the work from home activities into telecommuting, because telecommuting presents a new set of challenges in tracking employee hours and compensation. I think that, it's safe to assume that there's going to be, a continued increase in off-the-clock cases. So it's a good time to reinforce employer policies around, what schedules should look like for exempt and non-exempt employees as we kind of tackle what this looks like in a post-COVID world.
Yeah. And, shifting to another quadrant is looking at the D&O risk. I think one of the top risks would be, the receipt of all the CARES Act funds, right? Billions and billions have been provided by the government. And receiving that money, a lot of written certifications and other, representations have been made. And I think where the exposure comes is it's much later, because at some point in time, the government's going to conduct audits to see how that money was spent. And anytime there's a lot of money involved, you have the potential for quote unquote whistleblowers who may say, my organization used that money improperly and bring a false claims act. There's also the potential for anti-kickback exposure and other types of government investigations. And it's an increase in the regulatory risk. And we've actually seen this already. Kind of the beleaguered senior care industry already has some high-level investigations. There's a congressional investigation that's ongoing. So I think we're going to see more and more in the future. In addition to just COVID especially in the early months when elective procedures were shut down pretty thoroughly, almost across, in many parts of the country. With that declining revenue, we had a lot of what I would just say financial distress for our companies. We've definitely seen, a few bankruptcies arising out of it. And one kind of, I don't know that it's necessarily a COVID risk or a new risk, there's always the antitrust risk that stems from merger and acquisition activity. And looking at some recent reports, it doesn't look like that activity has really slowed that much in healthcare, even with the presence of COVID. There's still many big deals and small deals going forward. So I think we're going to see more there. And one area I thought could be even a future kind of risk is at some point in time, we hopefully will have a COVID vaccine, and we'll probably be turning to our healthcare clients to help distribute that. And, there can always be a risk there when there's money involved and possibilities of, allegations that, not as many vaccines were actually provided that are being charged for and things of that nature. And last but not least is employment practices liability. And I would think this is the risk there. I think some of these have been in the news, especially in the early days of COVID, about, certain employees raising safety concerns or seeking disability accommodations because they can't work during COVID. And of course, this really hits the healthcare industry because there's so many essential workers, right? Unlike a lot of the other types of industries out there where you could transfer a lot of folks to working from home, so many of them are doing their day-to-day job, and potential exposure to COVID may have other issues like that. So that's a potential. And kind of the next point kind of ties into what I was raising before about the financial issues. Because of some of the financial issues, we've definitely seen an increase in furloughs. We've seen some large reductions in force. We've seen some, salary reductions. Not all of the furloughs have ended. Not all the salaries have been reinstated. So anytime you have those types of things, there's a potential for it's an employment practices type risk. And then even when you bring back folks from working from home or from furlough, additional issues. Are you going to have the vaccination requirement? And if an employee won't do that, and you take an action against them, that can result in an employment practices claim. And one other area where we've kind of seen it rise as issues in the COVID arena was kind of employees reaching out via social media about some of the concerns they have at the workforce, and then employers then saying, you can't do that. And it's especially sensitive in the healthcare arena where you could be because of HIPAA and you can't disclose information about your patients, and sometimes there can be real concerns about that. So there are a lot of risks in the that COVID has presented, and we had a lot of risks, of course, that were coming into it. So this next slide is an interesting one because it helps you kind of see to date, what are we seeing with respect to claims that are COVID related? So what this is tracking, it's tracking all the claims reported to March since the COVID has began, and it's pretty current. It's only a few weeks off. And as you can see from the top box, the industry with the most number of claims is healthcare, followed by real estate, financial institutions, and entertainment doesn't come until much lower down there. And actually, I think the entertainment number may be a mistake. That should be much lower, so apologize for that. But healthcare by far is our leading one. And just to give you a little insight into that, the real bulk of the healthcare claims, and it should come as no surprise, are workers' comp followed closely by property claims. So, but within that healthcare bucket, there were, and now I'm looking down kind of the next little box, we're now looking at all industries and what type of claims are within certain types. And we really, since we're talking about management liability on today's presentation, that's what we focused on. So for what we call all the financial and professional lines, we've seen a total of 258 claims. And the leading claims in there are D&O and EPL, and those two numbers match up. I don't think there's actually been a lot of D&O claims. I think most of them are actually employment practices driven, but so many clients have blended D&O and EPL programs. If you report under one carrier, if you report under one coverage, you also report on the other. So that's what we're really seeing. Cyber follows closely behind that, and then some of the others, so we're not really surprisingly seeing as many claims in kind of the management liability space as we thought we might have. it's really been dominated by workers' comp. And Greg, kind of curious, Beasley's experience in this arena.
Yeah, and it's important to note, I guess, when I'm speaking to this, that I'm mostly speaking to the EPL, D&O fiduciary coverages, because that's where my focus is. But with that, it really just mirrors what you're seeing here. I think most notably, it's been less than anticipated thus far, and focused almost predominantly on the EPL side of things. So I think honestly they've tailed off a bit lately. And we really haven't seen anything on the D&O side of things in the healthcare space either.
So that's actually a positive trend. We'll take that. So moving on, now we're going to actually do a deep dive in potential COVID claims. So Nicole, do you want to lead us off in this discussion?
Sure. So yeah, I mean, I think that it's, we can't really gloss over the fact that there's been, the healthcare industry specifically, because of the, the halt on a lot of the elective procedures early on. Thankfully, a lot of the elective procedures are picking back up in many states. But because of the halt of elective procedures, especially through the first and second quarters, it really hit our health systems and health providers really hard. And just looking at, some of the stats from the American Hospital Association, the latest report that I saw noted that there are losses that will total up to $323.1 billion for the year for 2020. That is a really, really large number. And so if we look at the types of claims and just trends that we're seeing that there's been a huge financial impact to our clients. And so that there are, some concerns that our health care underwriters are bringing to light in terms of long-term insolvency or solvency, I should say, for our health system clients. So our health system clients are, having to talk a lot more about, what their current financial situation looks like and what their readiness plan was for PPE, and what those additional costs were, but then also providing forward-looking statements about, how they've handled the pandemic, and then, trying to give a forecast of what's expected and what their financial picture will look like in the coming months. Because there have been some increased concerns over insolvency, we've seen some of our markets look at including bankruptcy exclusions, which I will say is not something that we've seen, happen a lot. And we're definitely trying to, trying to have those deeper dive discussions with our clients and our carrier partners so that everyone feels comfortable with the risk profile that our clients, can speak to. Obviously, CARES Act funding helps, definitely helps in providing some solvency help. But it also brings up a really good discussion with our clients about Side A DIC coverage, directors and officers coverage. So we're seeing that our clients are looking at, buying Side A DIC policies or increasing those limits. And just a quick primer on Side A DIC. Side A DIC is an insurance product that is, there's three parts of D&O insurance, A, B, and C. The A side protects directors and officers specifically. I know that a lot of your directors and officers have, definitely might check in with risk management and, management team just to kind of check in from time to time on, how they're protected and sitting on the board of hospital organizations. So a Side A DIC policy would drop down to fill in gaps where a company's D&O tower or underlying insurer would refuse to pay. And a lot of times we would see in this policy respond in times of insolvency when there were no funds to provide to the Ds and Os directly. So I think that this is really important in just talking through, what your Side A DIC programs look like specifically. When I know our markets are asking a lot of questions about financial insolvency. Ruth already touched on the regulatory investigations that we're seeing from the receipt of CARES Fund. I think that's definitely TBD on what we're seeing, what the future will hold. But we've seen a couple of instances in other and other industries, not healthcare specifically, for some folks being investigated by the Fed already for how they've handled their CARES Act funding. Again, has not been something that we've seen or I have seen personally in healthcare, but definitely there have been some pretty striking headlines about certain other industry classes or people kind of trying to look at how best to use CARES Act funding. So I think that that's something, again, that remains to be seen, but definitely looking to keep a close eye on for our healthcare clients. In whistleblower claims, qui tams, they are such a huge source of a potential windfall for those whistleblowers, as we all know. Whistleblowers, if the federal government does agree to take up their claim that they present to the Fed, whatever settlement that becomes of that claim, there's a 10% windfall for those whistleblowers. So I think that's something just to keep our eye on, as well as CARES Act funding becomes, again, it's an ongoing issue that we need to continue to look at, but something that I think we'll continue to see, especially with False Claim Act whistleblower actions.
And now turning to employment practices, and Kelly and Greg, I would definitely like some of your thoughts on what you're seeing. But we talked about the risks a bit earlier on this slide, and now what does that mean? That means those potential risks can lead to these type of allegations, right, in the employment practices liability world. So we've definitely seen some employees raising safety concerns and maybe doing it in inappropriate ways via social media or even via just the regular media, and that could result in, then the employer may take some type of disciplinary action. There may even terminate them based on what kind of conduct they're engaged in, and that can result in an employment practices liability claim. And we've definitely seen a few of those early on during the COVID days. Some of those made the news, some of those claims. One area where, COVID has really highlighted some of the issues, and there's been a lot of social unrest in the last few months, and we are starting to see, an uptick in discrimination claims. The one below that, harassment and Me Too. Once again, Me Too is not something that's happened during the COVID period, but by no means has it gone away at all. And an issue that I think has what's happening with the social unrest, with the Me Too, is social inflation. And this is where, Greg, I would love to hear a little bit about your claims experience and kind of what you're seeing at Beasley on these issues.
Yeah, and I think specific to COVID, I guess what we've seen so far is really the retaliation claims have been the most prevalent on the EPL side. And like what I mean by that is a nurse or other employee complaining about some COVID specific concern, and then are terminated or otherwise alleged to have been retaliated against for expressing some sort of concerns. Like that's really been, I think, the vast majority of what we've seen. There's been a little discrimination type claims sprinkled in there as well, but specific to COVID, it's mostly been focused on the retaliation aspect of it. And I really passed at the other items on here, like the social unrest, the Me Too, just the general social inflation are really, they're not necessarily COVID specific issues, right? But are things that we all, I think, have to deal with really just on a day-to-day manner. And the Me Too portion, I think, is still an item that's still, it's still out there and still, I don't know if going strong is still too strong of a word for it, but, we're still seeing those. And I think coupled with the social unrest, are two of the other items that we just continue to keep our eyes on and how they might impact claims, just along with the social inflation generally. We had talked a bit about social inflation in the past, and my experience with it for the most part has really been and impacting claims in states that we already identify as the more like having a higher amount of volatility. And what I mean like that is your Californias, New Yorks, states in which a claim there is just inherently going to drive up the settlement cost comparatively to other states. The social inflation issues are driving up those already high settlement values there, I think, a little bit more than they might be elsewhere. other states where we don't necessarily see increased value, like in California, the social inflation hasn't really been as prevalent there than the already volatile states.
Yeah. Well, one area where we have seen pre-COVID is a real issue and a focus for carriers and clients alike is on physician-related claims, in particular in the employment practices space. So any trends you're seeing there, anything, have you seen an uptick in COVID, or is it, pretty much the way it's been? And I think one thing that would be, some insights that would be interesting for maybe the clients who may have been lucky and not seen those yet, is kind of the claims brought by physicians by employment practices, is what's unique about those claims as opposed to the, non-physician employment practices claim.
Yeah, so quickly before I answer that, it looks like there was a chat question on just what is social inflation generally. So to answer that quickly, it's like just when societal trends have an impact, like to increase the costs of the claims experience in general. So just like the current landscape with Me Too, social unrest, on how if those if Me Too wasn't a quote unquote thing right now, a harassment claim might be worth X, but it is driven up to Y as a result of societal trends involving Me Too that are out there in the market right now. So hopefully that answers that well enough. But specific to the physician claims, they're unique for a couple different reasons. I think oftentimes the actual substance of the claims are similar to the claims from any other employee, in that you're seeing discrimination, harassment, retaliation, like you might see from a nurse or from another employee within the organization. One cause of action we see from time to time, let me say that we see a little bit more regularly from physicians than others is defamation or defamation claims. And I think that kind of coincides with what makes physician claims a little bit more difficult in general. I'm painting with a very broad brush here, but two things that tend to set physicians apart from other employees within the organization are their salaries or their wages, like they're generally high wage earners, and B, sometimes physicians they don't like to be told they're wrong. They're used to running their own show and having things go how they want. And those are two items that make for a difficult plaintiff in a lawsuit. The wages, like setting aside the question of liability, a physician's salary, other wages generally lead to much more significant damages analysis and calculations, and what might be expected in terms of a potential settlement or judgment for that matter. And then also they're just, there's, again, extremely broad brush, but they oftentimes are a little bit more of a true believer, are set in their ways, thinking that what he or she may have done in this particular setting was the right thing to do, and like those things coupled together, oftentimes make those cases last a lot longer. Like they're able to weather the storm of litigation longer, and they want bigger numbers because of their salary and because they generally think they're right and aren't too interested in hearing that they might not be. Those are like the two big items that we see on the physician side.
Yeah, no, and I know another issue that we've heard with all the consolidation in healthcare. At times, if a physician is not able to work at one particular health system, sometimes that may be one of the best, if not only, options within a geographic area. So it becomes kind of it becomes even more vital that they fight it because they need the ability to work there. Not always, but we've seen some of that drive it as well. But there's always a lot here. Did we receive another question, Nicole?
No, so Greg, no, thank you for answering the social inflation question. That was the last question that we received.
Yeah,
got it.
But if I could, Greg, if we could just highlight too, have there been positive developments and claims trends that aren't necessarily related to COVID that you've seen in the past, 6 months or so? Have there been any positive takeaways that we can maybe cling to for those claims that might not be COVID specific?
Yes, and I just, I apologize, but before I answer that, I think Ruth hit on an important point too that we have with physicians that make the claims a bit more difficult is if they're separated from a particular hospital, oftentimes if it's not in a city, there aren't other areas to go to, other hospitals to go to, especially if you're dealing with a situation involving the rescission of privileges. Because I know, and I apologize, I don't remember the specific name, but there's a national database that type of circumstance has to be reported to. So if we have that aspect involved in a claim as well, oftentimes like revisions to reports are wanted or the physicians are wanting to return to work. And that's oftentimes, I think, a non-starter for the defendant. So that's just another real complicating factor in those cases themselves. So specific to positive trends, I mean, I don't know. I don't know if positive trends are the right way to phrase it, but I think the first thing that really comes to mind is there have been a lot of plaintiffs out there who have shown willingness to discuss settlement, I think on some level due to COVID and the uncertainty in the market in general, in cases where we might not have anticipated otherwise. So, I think, again, speaking specifically to our management liability practice in healthcare, but there has been a bit more of an uptick in plaintiffs and plaintiffs' attorneys reaching out saying, hey, we might like to try and get this case resolved.
Yeah. Well, it's always glad to have a little bit of light with everything else that's going on in the world that's so negative. So I just want to spend a little bit of time on this fiduciary issue. Nicole mentioned it earlier. This is not COVID driven, but it is an issue that has become a significant one. And I would say, in particular, in the last few weeks, it's really significantly impacting the fiduciary insurance market. So we want to make sure you're aware of it. This issue could be its own webinar. So we're certainly not giving it the time that it needs, but it's certainly enough that we want to kind of bring it to your attention. And please feel free to follow up with us on this one if you want more information about it. So what we're going to call is something that's got for shorthand excessive fees litigation. And to start with that, so what is that? Well, when you have all these plans out there, you typically have record keepers out there and you have an investment manager out there. And both of those, and often sometimes they may be the same folks, but they charge a fee, right? And as a ERISA fiduciary, i.e. the company or the person that manages the plans, you have a duty to make sure that fee is reasonable. We all know the word reasonable. It's launched, 1,000 lawsuits, in every area of the law. But what's happened are plaintiffs' attorneys have said that, all these plans out there, you aren't making sure that these vendors that provide these services are charging the lowest fee. You're not making sure that you're negotiating with them to get that fee down. We've seen all kind of different allegations, not just limited to fees. We've also seen where if you offer too many or too few plan choices, once again, that may be you're not doing what your duty is as a ERISA fiduciary and making sure keeping the fees down, making sure that you have the best investment choices out there for your plan members. Not a prevalent allegation, but we've definitely seen it pop up time as well. We've even seen arguments that as a ERISA fiduciary, you have to evaluate these record keepers and investment managers' cybersecurity practices, and if they have an incident, then you must have not done your duty to make sure that they had good cybersecurity practices. Why are we drawing this attention to you? This litigation really came to life in 2006. At the time, it was really targeted at large 401k plans, usually with billions of dollars in benefits in really large companies. In 2015, we saw the plaintiffs' attorneys kind of change their target away from the 401k to looking at 403b plans as well as all other types of plans. And there was a slate of these lawsuits filed against universities. And then a very developing and disturbing trend in 2020, kind of over in the last few months, we've seen kind of the traditional excessive fee case filed against several health systems. Some with large plan assets, some with small plan assets. So we have definitely seen an uptick in that. And these, some of the issues with these are these can be very expensive to defend. ERISA attorneys, it's a unique and highly niche area of the law, and these attorneys charge a lot, and to have a good one, their fees are high. So you can have very high defense costs, and we've also seen some pretty significant settlements over the years in these cases. So this is really changing the fiduciary market rapidly. And we definitely can talk about this. And if you haven't had a renewal and you have an upcoming renewal, you're with Marsh, you're going to hear a lot more about these issues. So Greg, Kelly, any comments you want to add on what's going on with the fiduciary market?
Yeah, I just quickly, maybe what I'm going to say lead into what you're saying, Kelly, I imagine. I just, if I were to have a conversation about trends in the market right now, this ERISA litigation would be items 1A, 1B, and 1C. Like it's just really spiked recently, and it's just an expensive lawsuit to defend due to the level of specialization that's needed, as was noted earlier. So I would just, to the extent that everyone on here has plans, and you have not consulted with a ERISA attorney around, regarding those plans, I'd really encourage you to do so, because it's just, we've been seeing these one after another, actually really prevalently in Wisconsin, due to a specific attorney there, but nationally as well. So with that, go ahead.
Yeah, I was just going to add, from the underwriting side, I think the fiduciary line of coverage, especially compared to, D&O and EPL, that the fiduciary pricing has, a lot of times in the market been weighted fairly light compared to those other lines of coverage, especially on package policies. And so I think that's why, you might be seeing some increases in retention and pricing, just because the increase in the frequency of severity and the excessive fee space is having, is forcing us to sort of rethink the pricing for that line of coverage. We do try to underwrite to the exposure with supplemental underwriting risks or questions for large risks. But, because these claims are fairly technical on ERISA laws and not really as simple as just asking a few, underwriting questions and moving on, often we are having to address with maybe class action retentions, sublimits, or just overall adjustments in fiduciary pricing lately.
Yeah, thank you. And I want to call something out that are on the slides. We're not reading them to you, but on several of these slides, you'll see a blue box on the right side, and we've just kind of put together some risk mitigation tips for you. Once again, these could be always expanded. We always have more information, but we wanted to highlight some of the key areas where you should be looking at. I think one of the issues that we hear about the most on this fiduciary is have outside ERISA counsel review your plan before there's a lawsuit, I hear a lot of requests about, have you had a request for proposal recently on your vendors? So you've established that, they have the best and most competitive fee. So moving on for a fiduciary. And as I said, if you have more questions about that, please reach out to us. We'd be glad to talk about it in more depth with you. So we're going to swiftly move on to talk about an issue that we can also have our own webinar on, cyber. So Nicole.
Yeah. So we thought that this would be a good graph to highlight for our discussion, just so that we can really look at the evolution of cyber risk, but the costs, because these costs are enormous and expected to grow. So according to the graph below that you can see here on the screen, the global cost of cybercrime is estimated to cost $6 trillion, which I can't even comprehend that number. That is a huge number, but that actually is double the cost that we're seeing in just 5 years ago in 2015, when we looked at a similar report. So, the thought is that with the recent shift of the employees, rushing to work from their home offices, and really and truly for the foreseeable future, with offices not really expected to open anytime soon, we're expecting that these costs are going to continue to rise. So we think that it's just important to call out the importance of security awareness with your employee population. Employees that might not have, had this type of intensive training I can say that, just for myself, I've seen and heard of, some incidents that have occurred because of, working from home, and there being, maybe some just potentially just, more lax security protocols in place. So we think that security awareness and training is key to help curb these costs as we head into, if you can believe it, the 8th consecutive month of working remotely.
I know. And, I want to hit a little bit quickly on the next issue. So I don't know that you can open up any type of news these days without reading about a new ransomware attack. I was reading just today that since the beginning of this year, ransomware attacks are up 50%. And it probably will come to no surprise to anyone on this phone call today that the highest targeted industry is the healthcare industry. And what we have on the right, as I mentioned in prior, is a few mitigation tips. These are really focused on ransomware, but honestly, they apply to all of these. Below ransomware, we have network interruption and data breach, but I would say for the most part, those often could be caused by ransomware, right? It shuts down your computer system, right? A network interruption. A large health system has recently experienced that, and I was reading this morning, I think they're just now starting to get fully back online. It's truly devastating to have one of these events. And just last week, the Office of Foreign Asset Control, OFAC, issued an advisory saying that if you pay a ransom to certain bad guys, in a lovely government kind of definition, specially designated nationals and blocked persons, if you pay those, then you could be in violation of some of the OFAC rules and you become subject to a sanction. So there's a lot of tricky issues when it comes to ransomware if you are the victim of one of these attacks. So constantly changing, very, very important issue. And where else have we seen a real issue? The Office for Civil Rights, which is the organization that often enforces HIPAA violations. So I think a lot of our healthcare clients are probably very familiar with them. Just last week, they issued the second largest fine ever against a large health insurer for a 2015 data breach. So they're still very active. And last night, they issued a $160,000 fine against a health system for an issue that's become kind of one of their new issues to really go after, which is providing patients with access to their medical records. So this was their 8th such fine issued within a relatively short period, I would say less than 12 months. So this is definitely a hot button issue. So with that, I think another issue that's really important these days that I think Nicole and Kelly can add some insights on is the next one, Biometric Information Privacy Act. So Nicole, I'll turn it over to you.
Sure. So the Biometric Information Privacy Act, or what we call it, BIPA, is really is a law that was passed in Illinois specifically. And it governs the collection, use, and storage of biometric information. So fingerprint, retina, anything that can identify you as an employee or individual is being really called into question right now. And again, BIPA is actually specific to Illinois residents only, but several states have similar types of laws that have been passed. California, of course. And then in a couple of other states, Texas and Washington, I believe too. What's different about BIPA is that there is a private right of action, and so it's just something that's a little bit different to note about BIPA. So the biggest targets are the health in healthcare industry is because how do we access documents? How do we access medications? How do you clock in and out? It's usually by, a fingerprint or a retina scan or something that is personally identifies you as an employee and in a healthcare setting. And just really quickly to note about BIPA, because these fines and violations can add up very quickly. There's a $1,000 per violation fine, and then it can be in upwards of $5,000 if the BIPA violation is found to have been reckless or intentional. So just something really important to know, that when you're, when you're looking at, these types of claims, these potential claims, it's also really hard to defend against as well. And in January 2019, the Illinois Supreme Court held that plaintiffs do not need to show that they actually suffered an injury other than a statutory damage. So I think that's really important to note. So again, very hard for clients to defend themselves in these types of claims. And then we're also seeing that our healthcare underwriters are seeing some of these BIPA type claims arise not only in a cyber setting, but also they're getting some claims within their EPL policy forms. So we're seeing that our underwriters are wanting to make sure that they can kind of carve out coverage where they feel the coverage should sit. So, specifically within a cyber policy. So we're seeing that we're seeing additional questions around BIPA specifically for Illinois residents and Illinois domiciled clients. But in general, just asking additional questions of all of our clients about, how they store and how they communicate is the biggest key, and how long they will be using individual employees' biometric identifying information in the workplace.
Kelly,
Yeah.
we love your insights on this one.
Yes, we would.
Yep. Sure. So, yeah, I mean, I guess maybe partially because I sit here in Illinois, we've been, familiar with BIPA for some time now. But from the employment practices perspective, like Nicole said, there could be some exposure, not just from a cyber perspective, but for collection of data from employees and the privacy issues there. And so there is some coverage available under an EPL policy, but I will say it's typically sublimited, sometimes to 250 or 500,000. But normally that's available, if and when a supplemental application can be completed favorably. And for those, it's usually a few quick questions, namely, in the past 6 years, has the client actually used any technology to collect biometric identifiers? So like Nicole said, that can be retina scan, fingerprints, voice print, DNA, finger scan, hand scan, et cetera. And it's important that we know not just what is being collected today, but what has been collected in the past few years, because there certainly could be a look back period as well as to those exposures. And if the answer is yes, that is potentially okay, but we would also want to know if employee written consent is obtained. Does that consent specify the purpose and length of time that the information is being collected? Does the written consent include a release? And then, of course, is there a written policy addressing the storage and collection and retention of that information? So it's something that we really do try to underwrite to on every risk, and it's very helpful to have that additional supplemental completed.
Yeah, and that's a great insight. Thank you. Before we leave the slide, one issue, once again, not a new COVID risk: social engineering, fraud, business email compromise. For those who may not, these are just kind of terms, but what this is often the fake CEO or the fake CFO email, where a criminal pretends to be the CFO and says, we have this deal, this, it's time sensitive, you need to wire transfer money to this bank account. And it turns out to be, all of it turns out to be fraudulent. We have seen a significant increase in both the frequency and unfortunately the value. In other words, it used to be tens of thousands, hundreds of thousands. We're now starting to see millions of dollars go through. And I think part of that is during the COVID period, it's the work from home environment, right? So you can't as easily walk down the hall and confirm, hey, do you really want me to transfer this money? So we've seen that a real uptick in that as well. So making sure that we still have time to finish anything, let's turn quickly to telehealth and some of the risks presented. Nicole?
Yeah, so, I think that this is probably something that telehealth impacts our healthcare clients directly because, obviously with folks not feeling comfortable or unable to go into doctors' offices and providers' offices, we've seen a huge jump in telehealth, obviously, since the lockdown started in March. On average, I was looking at a stat that was pretty astounding. I had no idea of the increase, but on average, providers are seeing between 50 to 175 times more patients than prior to the pandemic. And I think what's important to note is that, with a lot of systems, health systems and providers, rushing to set up what their virtual home doctor's office will look like, it could have been a challenge for some to make sure that their software platforms were HIPAA compliant. So just wanted to touch on that specifically, because obviously there's a need for people to be seen and for people to still be rendered, health services. But I think just keeping in mind that the platforms that are HIPAA compliant, if they're not, could lead to huge fines and penalties for health systems and providers.
Yeah, and I believe there's been some, kind of reduction in agreement of waivers of enforcement for certain telehealth and HIPAA during the COVID, but at some point in time, those waivers are going to go away and there's going to be full HIPAA enforcement. So that exposure is probably going to increase pretty quickly when that happens. I mean, the reality is anytime there's a rapid change in how care is delivered, there leaves potential for an IT gap, and telehealth is definitely one of those areas. And we do have some risk mitigation tips. And to be honest, these look a lot like, if you were comparing the prior slide to what we were suggesting with ransomware, it's a lot of just the same, it's very IT focused, what are the best kind of practices. So now let's talk about how all these things are impacting the management liability insurance market. So I don't want to spend a lot of time on it because I think most of us know this, but what was going on pre-COVID for healthcare, there were never a lot of primary insurers. It was a very small market. Beasley was one of the leading insurers, along with a couple other major carriers. We were starting to see this year some rate changes for all accounts, regardless of risk profile. And we had started to see coverage limitations and sometimes exclusions creeping into with respect to sexual misconduct, certain type of Me Too allegations, opioids, regulatory risk and antitrust were always out there and remain a concern. And they were always, we would see more underwriting questions on it. And we already had higher retentions and sublimited coverage for regulatory risk. So Nicole, let's talk a little bit about what's driving what we're seeing during COVID.
Yeah, absolutely. So I know that, we're talking about management liability line specifically today, but I'm sure you all are aware that in your professional liability renewals and discussions with your brokers and underwriters, that there's been a huge change in how a lot of those professional liability underwriters are viewing risk in a post-COVID world. So we're not seeing, a mass exodus of markets, thank goodness. But we are seeing that there is new business moratoriums on some clients or some specific risks. But what we're really seeing more that we're seeing is really significantly reduced appetite for certain sectors of healthcare. So we're seeing a lot of what underwriters like to call limit management. So looking at across their portfolio of clients, looking at how much limits are exposed to a certain client, and making sure that that is kind of reeled in a bit in a post-COVID world. So absolutely having a discussion, talking about where all of your capacity lies with your broker is really important, because you never want to be in a position where you're finding out that a carrier has to scale back maybe a D&O or EPL line because they've got 15 or 20 up on on a professional liability or work comp line of coverage. So we are seeing those types of things happen. We're seeing that the rate changes, unfortunately, are up more than they were pre-COVID. We're seeing on average median rate changes about 15 to 25%. We're also seeing, I kind of alluded to this a little bit earlier, but carriers really reducing their primary limit. So for smaller risks, we're seeing 1 to 3 million for smaller risks, and on larger risks, definitely no more than 10 on a given line. we're seeing more around, $5 to $10 million for larger risks and capacity deployment. We talked about this a little bit earlier, but definitely increasing retentions. High wage earners and physicians and medical provider retention specifically. Just one thing to note, when we're talking about high wage earners, really make sure that you're talking with your broker and understanding what the high wage earner salary band is. We've seen anywhere from 150 to 350 for a high wage earner band. So I think it's important, just from a risk management perspective, to kind of drill down into looking at who might fit that high wage earner profile. We always want to make sure that those high wage earners is really relegated to physicians only. So just a note about understanding what that high wage earner band might be, and really doing a deep dive into that. We're also seeing increasing retentions, unfortunately, for mass and class action lawsuits. And in a hardening market, that is a lever that we can pull in order to reduce premium as well. So just to being very mindful about what that might mean in increasing your retention today, and what premium savings you're going to have to make sure, look at cost benefit analysis and looking at long term, if that's something that you can, maintain a higher retention in the long term for your organization. And of course, antitrust. Ruth did mention, mergers and acquisitions in this climate are not happening as much as we've seen in the past, but what we're expecting is that, as we kind of come down from all of this COVID activity, that some of the systems and providers that might have needed additional financial support, might be looking to partner with a larger provider or health system. So we're not seeing, all those antitrust claims that are happening right now, but we're expecting that might be something to look for in 2021 and 2022. And with mergers and acquisitions means there could be potential claims. So definitely looking at increased antitrust retentions as well in a post-COVID world. And again, talking about financially distressed companies, it is becoming very hard to make a case for capacity with some entities and healthcare entities that are financially distressed.
Yeah, and Kelly, would love your insights on the market, and then more importantly, what do we do to counter what's going on in the market? Some kind of best practices. So,
yeah, sure.
Over
and
to
I
you.
Think, sure. And I think, on the market, one thing that we didn't really talk about, and maybe it's probably obvious to everybody, but just the economic downturn and recessionary environment, I think, really creates increased exposure on the employment front. That's true in healthcare and outside of healthcare. I think one thing that we definitely learned this time around for sure is that healthcare is not recession proof. And, we've seen a lot of our clients have to, go through layoffs, unfortunately. So that, on top of the COVID sort of financial impact, social unrest, which was layered on top of the Me Too harassment, equal pay claims, which have been increasing over the past few years, which is layered further on top of physician claims and antitrust claims, that have always been in the healthcare management liability space. I think, that's why all of this is really just sort of coming together all at once and leading to a lot of the some of the changes that Nicole mentioned. But in terms of, how to move forward, how to get through it, I would definitely say, we all agreed that starting early is, number one, and having those discussions well in advance of the renewal, because, there might be more questions than maybe people are used to, and which lead to follow-up questions and renewal negotiations. And it just, nothing is really done quickly these days, as much as we all try. So I would say, definitely get started early. Providing current financials, very important. If the year-end audit was done in 2019, a lot has changed since then. So we would, encourage getting really current financials. And then I would also really encourage, having conference calls or WebExes, or having those discussions with the underwriter and with the client, I think really helps us get our arms around what our clients are facing, how they're managing through it, and to just talk through it sometimes is a lot easier than back and forth emailing with follow-up questions. So those are my thoughts as we try to navigate through all of this.
Okay, great. Well, I think that we are at the top of our hour. So I think if there are any questions that we didn't get to, we'll definitely be reaching out to you specifically to make sure that we address any concerns or questions that you might have. I believe there's just one, but just keeping in mind that we're at the top of the hour. We really appreciate everyone dialing in today, and just taking some time to think about all of the emerging issues and hurdles that we're facing in the last quarter of 2020. We look forward to
thank you. Thank you very much.
Everyone soon.
Yes. Thank you for joining us, and thank you, Beasley, for joining us as well. Have a good afternoon.